we move to our first and very interesting panel discussion on the economy, where we're joined by stalwarts from the industry. And it certainly promises to be a stimulating conversation. And hence, without any further delay, allow me to begin by inviting the moderator of our panel discussion, Mr. D.K. Joshi, Chief Economist, Crisil Limited. Welcome, Mr. Joshi. I would now like to invite our eminent and esteemed panelists for today's session. We have with us Dr. Pronab Sen, Program Director, IGC India Program, and ex-Chief Statistician of India. We welcome you, Dr. Sen. Next, we have with us Mr. Neelakanth Mishra, Managing Director, India Strategist, and Co-Head of Equity Strategy Asia Pacific at Credit Suisse. Welcome, Mr. Mishra. We also have with us Dr. Niranjan Rajadhyaksha, Research Director and Senior Fellow, IDFC Institute. And our final panelist is Dr. Samiran Chakraborty, Managing Director and Chief Economist India at Citigroup. Thank you for joining us, Dr. Samiran. A warm welcome to each one of our panel members. And before I hand over the session to Mr. Joshi to take the discussion forward, may I request the participants to post your questions in the Q&A box on your screen, and we will try to take as many of them as possible during the end of the session. Over to you, Mr. Joshi.
Thank you very much, Pushan. Hello, everyone, and welcome once again to the Outlook event. We have four very eminent experts for this panel to discuss the contours of the recovery, the prospects for the next year, and also some of the challenges that we face in the coming year. It's almost 1 year since the pandemic struck, and the initial hit to the economy was much more than people were anticipating earlier. That led to a series of downgrades in India's growth outlook. But the recovery has been also very sharp, and I think that, along with the fact that we managed to successfully bend the COVID-19 curve, that has led to upgrades in growth outlook. But clearly, we are not out of the woods. As somebody had said, no one is safe till everyone is safe. Vaccination has started, but the virus is also mutating to survive. Looks like stamping out COVID-19 will be a long drawn affair. And I think it will take some time before we return to the pre-COVID normalcy. Well, in India, COVID-19 has stayed low. It's down, but certainly not out. The good news is that we got a head start on vaccination. Even before the second wave could strike, we started our vaccination program. But the effective vaccination for such a large economy is going to take time. And this, along with the herd immunity, will take some time before to normalize the situation. Well, with that brief introduction, let me launch straight into the panel discussion, and let me start with Neelakanth. Neelakanth, what is your outlook for the economy? And if the second wave indeed strikes, what does it mean for recovery? And very specifically, will the second wave be as damaging as the first one, if it does happen?
Thanks, DK. Thank you for inviting me, and a pleasure and a privilege to be speaking here. So my expectations of the recovery are quite a bit more optimistic than what Deepthi has currently forecast. And I think that the FY22 over FY20 growth is what we should really measure. There is a certain reluctance among forecasters, and that includes me, in putting numbers which appear high, like, how can we grow 13% or 14%? The way I look at it is that if you remove all hindrances to growth, you allow people to work, the 55 crore workers in India will produce a certain amount of output. Now, that's not dependent on what they produced the previous year. And I think that while the framework that I think Deepthi had, I think it's a very useful one, and we should all follow that the trend line, the gray line, as it keeps moving up. So it should have been 13% above FY20, so 113 over 100. And consensus government also is at 102, like Crisil is. I think the markets, the stock markets, I think I would say even the bond markets are sort of at 105, 106. I think we can get to 107, 108. So there is a significantly better growth outlook than what consensus is at right now. I think that this is still below the 113 watermark, and it will take a while to get there. So I would assume, if we are doing policy prescriptions as well, that I think policy should remain easy. The second wave and of the pandemic. So the numbers are rising. The good thing is that the deaths are not rising. So the deaths have remained in the 90 to 100 range, and so the infection fatality rate, which anyway was like 0.05, 0.06%, is something that I don't expect will change. Of course, if it changes, then of course, then the lockdowns and the fear among the people will be quite a bit more serious. As of now, that's not the expectation. The hope is that in the next 2 months, as most of the vulnerable population is vaccinated, the second wave of the pandemic will not necessitate economic lockdowns. So as you said, will it be as damaging? It doesn't appear to be as damaging on the health front. And the only reason earlier it was damaging was because of the lockdowns. So if the lockdowns are not being imposed, I don't expect the recovery to get totally pushed out. Now, even schools, I don't think they are shutting them down again, not yet anyway. And that was pretty much the last sector which was badly affected by the lockdowns.
Thanks, Neelakanth. I think the lesson also from the second wave in the West is that even if the lockdown became stringent, the mobility was not impacted to that extent because people had learned to live with the virus. So I think same kind of phenomena is likely to play out. And this incidentally is a question which many people are asking about the second wave. I think that seems to be the in top of their minds. Now coming to you, Dr. Sen. Well, we all know that we need reliable data for making effective policies. And during a pandemic, I think the policy plays a much bigger role. I'm reminded of a speech by Ben Bernanke, I think, which he had made before he became the Fed governor. And he said, and I quote, if monetary policy making is like driving a car, the car is the one with an unreliable speedometer, a foggy windshield, and a tendency to respond unpredictably and with a delay to accelerator or brake. Well, I think this is for a developed country and during normal times. I think during COVID times, the speedometer would be even more unreliable, which measures the speed of the economy, and the windshield, of course, foggier, because as we have seen how the forecasts have bounced up and down, I think. So in this context, I think we have had two advanced estimates of GDP for 2021, and they were released very close to each other, and they're not very different from each other, and -8% versus -7.7%. So I think since you have huge experience in this area, what kind of surprises should we be prepared for, I think, when the provisional estimates are out in the month of May, or the revised estimates come out next year, because there has been a lot of disruption and a lot of information is not available. And I think as a follow-up to that, I think if you could also answer that, I think what kind of policy framework or information should government policymakers rely on to design their response to the pandemic, when I think when the official statistics, I think across the world are somewhat weaker. I mean, should we risk erring on the side of caution, even if I think and rely more on the perception, so to say? Dr. Sen.
Thank you, DK. Thank you for inviting me to this panel discussion. As far as the data is concerned, I mean, I think all of us know that the Indian quarterly estimates actually measure a fairly small part of the economy in terms of the direct data availability. And there's a lot of extrapolation that is done based on relationships that have been derived from the past. The real issue is, do those relationships continue to hold in these extraordinary times, or have they changed? If you believe that they hold, then the estimates are reasonable. But if you believe that they do not hold, then the question marks on these estimates become large. Now, you asked the question that, will these numbers change dramatically when the provisional estimates come out? And the answer is no. Because when the provisional estimates come out, fundamentally, there is no additional data that's coming in. It's just more complete set of what you are measuring today. When it comes to the revised estimates, which will come later, there is the potential of capturing data on the entire corporate sector rather than just the listed companies, which is the current situation. That could actually throw up a lot of surprises. Already, and I think this is shown up in the the second advance estimate, that the smaller listed companies whose data came in a little later do not seem to have performed as well as the larger. Now, if that's the case and we go to the full universe of companies in the country, I think there could be some nasty downward shocks. But even then, we'll still be incomplete. And we will be incomplete because we would still not have measured the unorganized sector. So other than the unorganized sector in agriculture, the rest of the unorganized sector, which is 27, 28% of Indian GDP, would still not be measured. You would still be extrapolating it, but extrapolating it on a somewhat different base. So whether we'll have that information available by then, it's difficult to tell because data collection has become a serious challenge in India, much more so than in other countries, for the very simple reason that the nature of the unorganized sector in India is such that the only way you can collect data is really through survey instruments rather than through reporting systems. And surveys have become very, very difficult to carry out in the current scenario. So I wouldn't hold my breath on that. As far as the policy framework is concerned, look, I don't think in the Indian condition you can have a policy framework for data collection in a situation like we faced with COVID. COVID was unique because standard methods of data collection were simply stopped. They could not be carried out. There are very few events which lead to that situation. By and large, data can be gathered, provided that the field investigators are able and allowed to move around. So the question is not that. The question really is that what I think has really come to the minds of the policymakers, that for the unorganized sector at least, we do need more frequent information. And therefore, the nature of our data collection system will have to adjust to that. It's a challenge, but I'm sure we'll get around to it. But more importantly, if you think about what I had said, that the company's data, that is for the universe of all companies in India, that data you're not going to be getting till, so if you think about the FY21, you will probably be getting that data somewhere around December 22. All right. Frankly, that's the area where we need more information and we need it faster. So we are going to have to put systems in place. We will need the cooperation of companies, particularly listed companies are never a problem because they're used to quarterly reporting, but unlisted companies are not used to it. And I'm not sure whether they are nimble enough to be able to provide the information in the manner and form that is required. And most of this would be unaudited. So that's going to have question marks somewhere, but that's something we're just going to have to live with.
Thank you, Dr. Sen. I think that helps us. The data is incoming. It helps us interpret it properly. I think not to overreact to it and be cautious while interpreting that. I think staying on the policy, and I now move on to Niranjan. monetary and fiscal policy intervention has been very critical. I think Sean was also pointing out, I think, and it has played a very critical role in fighting this crisis. You have earlier argued that fiscal policy should play a bigger role in tracking the pandemic, in tackling the pandemic, so to say. And rightly so, because last mile interventions are done better via the fiscal policy. Well, in the beginning of the crisis, monetary policy did take a role in India, and I think it continues to support. But I think the interesting part was that in fiscal 21, both the policies were very well coordinated. And despite there being huge discomfort on inflation, the situation now seems to be changing, and the trade-off and challenges are rising between monetary and fiscal policy coordination. So how do you see this scenario evolve in the coming fiscal year? Niranjan?
Thanks, DK, for inviting me here on this panel. So undoubtedly, I think that the monetary fiscal coordination is going to be a very tricky task in the coming, not just coming year, but I think the next few years. I think it's both a tricky technical task and a political economy task. So if you look at what's happened in the recent months, so if you just look at the sequence of events, if you remember in January, the RBI had indicated that it would start normalizing liquidity, and then the bond markets reacted rather sharply to that. Then the RBI sent out very strong forward guidance that they would continue to provide ample liquidity. It's interesting that in the new RBI bulletin, there's one phrase which caught my attention where the RBI speaks on that episode as naive adventurism of some bond traders, So for the central bank to think that the bond market reaction was adventurism is an interesting take, I thought. And then we've had a lot of evolved issues which have devolved, the sales of government securities. Now, I think, DK, that obviously I agree with your Crisil's assessment that bond yields are going to start inching up. They have started, and they will inch up further through the year. I think if you look at it in a slightly, theoretical way, I think the key policy choice for the RBI in this year or a little ahead of that is whether they want to clear the market through prices or quantities, right? So if they want to clear the market through prices, they have to let bond yields go up. If they have to clear it through quantities, then they have to step in and buy more government securities through OMOs, which has its own set of problems. So I don't think it's a binary choice. It's going to be some combination. But I think the RBI is really facing a conundrum on this because, in April, I think the CRR cut will be reversed. At least that's what they've said, which will suck out around 1.5 trillion rupees from the money market. So as for now, what we are seeing is a tug of war between the RBI and the bond market. We are seeing it in many other countries. And as long as inflation is muted, I don't see it as a major issue. But my worry is actually a slightly longer term challenge for the RBI of how to, manage its monetary policy given the fiscal expansion, because the government has indicated a very modest fiscal glide path, right? To come back to close to the FRBM levels, it's going to take us 4 to 5 years. The Finance Commission, the 15th Finance Commission, in its report is basically saying that public debt to GDP, even in FY26, will be about 85%, right? Which is way, way higher than what every previous, report or every previous committee had recommended. So there's going to be really large demand on domestic savings by the government, and how an inflation targeting central bank manages between, being committed to its inflation mandate and, getting funds for the government is going to be an interesting, or actually just a challenging task for the RBI, according to me, especially once private sector demand for funds goes up. Currently, it's still muted, all said and done. But once the private sector demand kicks in, how the RBI is going to balance between, maintaining its inflation target or being true to its inflation target and managing the government borrowing program, not just this year, but in the next 3-4 years, is going to be a massive challenge. And as I said, it's also a political economy question. I don't think it's purely a technical question. So, as people who followed the economy long enough know that 97, there was this famous agreement between the RBI and the finance ministry, which basically gave RBI more independence because automatic monetization of deficits stopped, etc. So I don't think we are as yet in a situation where we can say there is fiscal dominance of monetary policy, right? So as of now, I don't think the accommodation of the borrowing program is overwhelming the rest of the monetary policy goals, or at least the main goal of inflation control. But I'm not so sure in the next few years. So if you remember, the Urjit Patel committee report had basically all its analysis was based on this implicit assumption that the FRBM targets will be met, and we are way beyond that now. And for a sustained period, we're going to see large government deficits. So definitely fiscal dominance is not an issue now, but I would worry about it if there is no credible fiscal consolidation plan.
Right. I think right now most governments, central banks, I think they adopted a fire hose approach. I mean, you have to get the pandemic out of the way. I think we'll think about the other issues later. I mean, that seems to be and the views are very divided. I mean, even for advanced countries. And I think on one of the views that is where there is some division is inflation. India, and I'm coming to Samiran now, India had its own, I would call it inflation tantrum in 21. And the central bank decided to see through it, and rightly so. I think it's really ironical that since inflation targeting was introduced in 2016, India saw the highest inflation in a year when the GDP contracted the most. I mean, and I think, and even the global inflation was down. And now I think we are seeing the chatter on global inflation go up. And I think even our forecast on inflation is that it will mildly come down. So Samiran, how do you see the inflation threat in this era of recovering economy, rising crude prices, which have crossed 70, and also commodity prices, which have risen quite a bit, and the core inflation, which kind of remains sticky in India?
Thanks, PK, for inviting me to this esteemed panel. So on inflation, I think there are 3 different kinds of decoupling that I'm going to talk about. The first decoupling is between Indian inflation and global inflation. The second decoupling, kind of following from the first one, is between CPI and WPI decoupling. And the third one is how inflation is going to be different from the bond market perspective versus the equity market perspective. So if you look at the first decoupling between global and Indian inflation, as you rightly say, in 2020, global inflation was low, Indian inflation was relatively high. So if not for anything else, this year the base effect will run on the opposite direction. So this year, just base effects will push up global inflation, but would most likely be pushing down the Indian inflation number. But let me quickly go to the second decoupling, which is kind of connected to the first one, is that how much does CPI get impacted by global inflation? Our estimate is that only 7% of the CPI basket has any correlation with global prices. That 7% of the basket right now is growing at 14% year-over-year. But it's just so small that it does not move the headline CPI that much. Particularly if you go to the food part of CPI, which is almost 50%, we find that only for sugar and edible oil, there is a significant correlation between global prices and Indian prices. Other than that, for most of the food items, it's the local factors which drive it. Now, I do understand that there is one risk that when the MSPs get announced, if the MSPs explicitly take into account global food prices, then who knows, rice or wheat MSP could also be increased substantially. That can feed into the CPI as well. But till that happens, we might not see a significant pass-through of global commodity price increase into CPI. But this is not the story with WPI. WPI has almost 40% of its weight coming from global commodities. And that's where you might see almost a 1-for-1 increase or a pass-through from global prices, which could be more worrisome. And now why I'm making this distinction between my third point about the bond market and equity market is that bond market is likely to look at the headline CPI to judge what RBI's response function could be. Now, we know that after the GFC, we had this problem that we were tracking WPI and CPI was creeping up much faster, which led to some kind of wrong policy choices. There is a risk that this time we will be tracking CPI in the monetary policy space and might remain a bit more relaxed about inflation, but the underlying price pressures could be very different. But be that as it may, the fact that we will be tracking CPI from monetary policy choice perspective, bond markets will be relatively comfortable. Equity markets, the difficulty is that this whole input price pressure is either going to show up as margin pressure or it's going to show up as demand pressure if the companies are passing it on as higher prices for the consumer. So that's where I suspect that the inflation talk will be more generic and more worrisome. But whatever it's worth, our current CPI projection for FY22 is about 4.8%, but that's with oil at $60 per barrel average. If you put it up by another $10 per barrel, then probably you have to push up that inflation forecast by about 50 basis points or so. So let's see where oil settles, because that's going to be one of the key drivers of inflation in India.
If I may just ask a quick question, which audience had posed, which is when do you see RBI normalizing rates? Very quickly, Samiran.
Well, normalizing rates is not a 2021 story, it's more a 2022 story. 2021 would be a story of more normalizing liquidity. And to that extent, the short end of the curve would adjust in 2021 itself. The long end would react in 2021 more to global issues, whether it is US Treasury yields or to oil prices, etc. I don't think RBI necessarily will try to push up the long end so much in 2021. And policy rate hike is a 2022 story for sure.
Yeah, thanks, Samiran. And I think the theme of our Outlook event is investment. So let me now move towards that, and I'll stick on with Samiran. Samiran, you look at the investments and the nuances quite closely, and we all have been waiting for a meaningful revival of investment cycle for quite some time. How many boxes for private investment pickup are getting ticked at this juncture? I mean, do you see preconditions increasingly being met for private investment to return?
Well, it's an interesting backdrop, because who would have thought that in the post-COVID GDP data, investment is the only component which is showing a year-over-year growth. In fact, all the proxy indicators for investment are also showing a much more rapid recovery than any one of us would have believed 6-8 months back. Now, the fact is that if I look at the preconditions of lower interest rate, higher corporate profitability, lower tax rate, lower private sector leverage. I mean, if you look at the private sector debt, it has come down from more than 70% in FY13 to just about 60-odd% now in before the pandemic. And hopefully this period of high inflation has lowered this private sector debt even further. So these are all from a macro indicators perspective, suggesting that some of the preconditions for private investment is in place. And then if you look at some of the other issues, like we look at the asset turnover ratio for different sectors, while we see that the capacity utilization rate at an aggregate level has not reached the point where we can justify fresh capex at an aggregate level. But sectoral indicators like asset turnover ratio indicate that for certain sectors like consumer durables, some export-oriented sectors, it's already reaching a point where it could lead to more capex. And then the third issue is about the government schemes to drive private capex. So some of these PLI-linked schemes, some of the issues around how government is trying to put both tariff as well as non-tariff barriers, almost sometimes banning certain kinds of imports. That would also lead to some domestic capacity creation. And last but not the least is the construction sector, the real estate and infrastructure. This is a segment which has really done exceedingly well, even post-COVID. There are enough anecdotal evidence of things going on much better than expected. And this is a key component of the overall investment cycle. So all these things point towards a better private capex recovery, according to us, going forward. The key risk is that the kind of risk appetite in the system, if it fizzles out somewhere quicker than what we are expecting today, because some of the large projects which drove private investment before in this is going to be its relative projects in multiple sectors. Now that is a risk that if the positivity does not spread into all these much faster than we are anticipating today. But I want to hear from all of you also your views, because this is appears to be.
Thank you, Samiran. We seem to be losing you. I think I want to stay on this topic and come to Neelakanth now. We have the PLI scheme, which I think is supposed to break the cycle of investment in some sense, that it will push investments up in a short period of time. So this is, in a way, I think, a disruption for manufacturing sector, which could see its share in GDP rise. I think it has been stagnant for quite some time. So how do you think the PLI scheme is going to benefit the manufacturing sector? And also, I think within that, I mean, are there some winners and some losers? And from this, Neelakanth?
Yeah, so I kind of agree with Samiran that this is the investment revival is, I think, going to last. And the most important thing is the signaling from the government. After a long time, we are seeing the government signal that it desires higher growth. And the PLI scheme, the launch of the PLI schemes, especially the second batch, which was announced middle of November, was a clear sign that it was willing to put a lot of money behind it. Now, there will be debates and discussions, and I think there are risks and pitfalls that we need to all guard against. But that, we are going back to the days of industrial policy, import protection, and crony capitalism and all that. But I think the right path is somewhere in the middle. I mean, there is some need for infant industry protection in India as well, and you are starting to see signs of that, right? So the electronic scheme, which is the handset scheme, which is the only one which is sort of currently in execution, is already, I think, doing very well. The supply chain shift to India, the initial signs are very strong. There is, domestic large business groups are also starting to show interest, and investments have actually started on the ground. So land has been acquired, activity has started. This by itself, in the first wave, may not be enough, meaning the choice of sectors that the government has is mostly where the business is labor intensive, because that's where India's, there is an outflow of business from China, partly because of geopolitics, but mostly because they're running out of people. And so people is what we have in abundance. And those are the sectors that the government is targeting initially. So that may not be, while it'll show up in, I think, big jumps in production. The Prime Minister noted, I think, $520 billion over 5 years, which is substantially higher than what we had in our numbers. In our view, we had estimated about 1.7% of GDP being added because of these schemes in the fifth year and in FY26. Now, the investment requirement in the first year itself may not be that dramatic, but as the upstream businesses come in, so to give you an example, handset assembly does not require too much of capex, right? But the moment you start getting into printed circuit boards, you start getting into, say, even semiconductor packaging, you start getting into, say, camera modules, image sensors. Image sensors, I think, will take a while, but as that starts to happen, the capital intensity of the supply chain goes up. So I think the objective is to get the downstream in, get the customer through the door, and then finally, and over time, that customer then builds in the supply chain locally. And we are starting to see some of that happen, right? So like in Tirupati, already camera module companies are setting up shop. Many of the assemblers are moving up. So this is just electronics. Take apparel. Right? Garmenting is very labor intensive. So if say man-made fiber scheme leads to some investment, it will be a small one. But if that means that the man-made fiber, that whole supply chain from textiles and then yarns, all starts to get set up, that will be a lot more labor intensive, but capital intensive. So I think that this is a multi-year surge. The interesting thing is that most of the PLI schemes will start FY23, but the investment for that is likely to happen in FY22. So this is far faster than what would appear to be a pretty long drawn setup. But I also think that the very fact that the government is pro-growth, that the government is happily using terms like privatization in budget speeches, is a strong signal to the private sector to revive their sort of instincts, the animal spirits. And we are starting to see that, right? Like several paints companies have brought forward their capacity expansion. A cement company is now starting to invest. A global major steel company has announced a greenfield plant. These are things that we hadn't seen for 10 years. And therefore, so this is a very good sign that the private capex environment is actually going to be quite conducive in the foreseeable future.
Dr. Sen, if I may bring you in here, I think, so this is about, well, there is some increased possibility of private investment, but investment has to walk on two legs, and the infrastructure leg is largely government-led. Do we have enough resources to fire the kind of investments that are planned in the national infrastructure pipeline, which will also be very critical for the success of private investments?
I think it's more than that. The figures that we are getting in the GDP estimates for investment, in a sense, I think understate what private investments have been doing, because there is clear evidence from the state government budgets that state governments have cut back on investments, and state governments within the government context are the largest investors. And there's been a significant cutback there. Now, if there has been a cutback, the question really is in terms of crowding in private investment. When will the state governments be in a fiscal position where they can restart those investments? Because otherwise, what you're going to get are infrastructure constraints, which will be biting into private investments very, very quickly. So that, is, to my mind, is the real challenge. And from what one has heard, both from the central government's position on what the states can do and cannot do, and from the Finance Commission recommendations, the states are going to have a lot of problems in restarting their investment programs. Now, how strong this effect will be is very difficult to say. But certainly in terms of the geographic dispersion of investments, I think there's a huge issue that we need to keep in mind. So what you could be getting is that the geographical dispersion of private investments may actually narrow down quite dramatically. The national infrastructure pipeline in and of itself is a good thing, but the fact of the matter is, if you look at the projects which are in that pipeline, these have very long lead times. Neelakanth was talking about, 2-year lead times, but the NIT projects have much longer lead times than that. So I wouldn't hold my breath on that in terms of reviving the investment cycle. All right, that's not going to happen in a hurry. Where it could happen is if state infrastructure development revives, because those are smaller projects. Those are projects which can be gotten off the ground within a few months. So it's the composition of public investment which is of greater concern to me at the moment than the quantum.
Thank you, Dr. Sen. I think that puts the overall investment scenario in perspective. And I think also the policy of simultaneous import substitution and export promotion. I think we know that tariff levels on imports have gone up. India is not a part of the regional trade agreements. So there is an inward focus or bias in the policy. So is this consistent with industrializing the economy or raising the share of manufacturing in the GDP? And I think the more important part is who will be the final beneficiary? I mean, will the consumer benefit out of this approach? Niranjan?
Oh, so, sorry, I lost you, so DK. I didn't. Yeah, so, yeah, thanks, DK. I missed part of your question, but I think I've got it now. So, see, just step back a bit on the Atmanirbhar Bharat program. It's interesting that it has never been very clearly articulated what the government means by Atmanirbhar Bharat, because there are elements of import substitution and there are elements of export promotion because, of joining global supply chains, etc. So I think there are, if again you break it up into two parts, there are the PLIs which Neelakanth spoke about, which are largely subsidy programs, and there are some positives in these PLIs, which is, they do sort of give importance to scale. There seems to be a sunset clause. It's limited to a few industries. Although I don't know, we'll know only later whether these things change, that will the sunset clause be extended? Will the number of industries change, etc. But generally, industrial policy works best, if you look at China or Korea or any of these other countries, we're not just getting these anchor investments, but getting the forward and backward linkages also in place. And that includes, of course, the infrastructure issue is also there. So Neelakanth did mention that some of these linkages are working, yeah, so that's as far as the PLI scheme goes. See, what actually worries me more is the tariff hikes. One is purely from an ideological point that, India should be a trading nation. We should, take advantage of the global economy rather than being inward looking, especially after our bad experience with the previous episode of substituting industrialization. But since 2018, tariffs have been raised on about 3,500 to 4,000 items. And what worries me is not just the extent of tariff hikes, but one doesn't get a sense of what the method in all this thing is. I'll tell you what I mean. Let's see, we're all talking about the nominal rates of protection right now. The tariffs have been increased from 10 to 12 or 10 to 15. I think what actually matters for trade and industrial policy is the effective rate of protection, because there's an entire supply chain. And if you look at the 90s trade reforms, they had very clearly thought about the tariff rates on inputs, on intermediate goods, on capital goods, on final consumer goods. I'm not sure right now whether I see a consistent pattern in the trade, the tariff hike. So my concern actually is that we are actually putting the effective rates of protection are perhaps far higher than what the nominal rates are suggesting. We may even have cases of inverted duty structures. The point is that if we actually have high rates of effective protection or higher than what the nominal tariff rates show, then it's likely that consumers will suffer, right? So just coming to your point that it's not easy for to believe that if you have significantly high effective rates of protection, there won't be some rent seeking in the economy. And it's another issue which I think is worth thinking about. I don't have a clear view about it, but if there is sort of an impossible trinity here, that if you are seeking protection, then you have to either choose between scale or domestic competition. If you go for scale, then your domestic competition will suffer in a protected economy. If you go for domestic competition, then your scale, because you'll have, what we used to have, all these SSI reservations, etc. So I think that it's, these tariff hikes are a cause of concern. I don't think they are the best news for consumers. And it will be good if the government come with something like a white paper to explain what the underlying structural logic of these tariff hikes are. About PLIs, I'm less concerned about. I think there is some value in that sort of intervention.
Yeah, Dr. Sen, I think I wanted to very quickly ask you one question on, I think there's been a lot of talk about the distributional ill effects of the pandemic. I think it's amplified many of the inequalities in the system, small versus large company. We already, even in Crisil's study, we find out. So what do you think government can do more to address these dichotomies? I mean, is relying on growth to erase these dichotomies a good strategy? Or you need to do much more for them to erase them?
Sorry, DK, you need to do much more, because if you guys think about what we've been talking about and the good things that the government has done, and if you try and identify which segments of the economy are going to benefit, it's almost invariably the large. So active government policy being conducted today is actually making that dichotomy worse. So the distributional problem is made worse by the policy that we have. In trying to correct for it, the government would have to completely switch direction, because resources won't permit otherwise. One of the most important problems that you face is today, I mean, let's talk about PLIs, for instance. What is the PLI doing in effect? And this is what I think Niranjan was talking about, is the PLIs are actually tilting the game in favor of those who can take advantage of PLIs. And these are large units. Small units simply will not be able to sign up. Think of the nature of the central investment projects. Those are, again, mainly for larger entities. The banking sector, the financial sector in its totality, has completely shifted focus away from the SMEs towards the large. Every parameter that I can see, including government policy itself, is biased against the smaller units. Now, for the government to do a complete U-turn at this point, I think is practically impossible. I don't think that can happen. There would be too much loss of face. And I think it would be worse than that. I think the government would create a situation where the level of trust in government would go down. So I'm afraid we are in for a rather extended period where the distributional changes which were unleashed by demonetization and the lockdown are going to be made worse by the government's policy response at the moment. That is my real fear.
Yeah, even though growth may go up. So I think Yeah. On a related issue, I think coming to you, Neelakanth, I think the service sector, we all know, has been impacted quite badly by the pandemic. Particularly, I think when we talk of the contact-based services. Now, I think if these services are not doing well, then people employed in these services will also not do well. So is there a possibility of an adverse feedback loop from services back into the manufacturing? So which means that the manufacturing recovery that is currently going on because of high demand, that could be somewhat compressed, because I think the service sector will kind of hold it back.
I think it's a very important question, DK. So to put the manufacturing demand in context as well, this is part of the upward swing of the supply chain bullwhip, which the downward swing we had seen after the IL&FS debacle in 2018, where there was aggressive destocking throughout value chains. And then manufacturers saw a very sharp decline in apparent demand. This is now reversing on the other side. So some of what we see is just a reversal of what would have happened in March quarter last year is happening now. And it is actually to some extent happening globally as well because of the pandemic slowing down production in the first 3-4 months of the pandemic in every country. And which is part of the reason why some of the commodity price increases we are seeing. Let's see how addicted the US gets to its fiscal stimulus. But with that caveat, I think that this adjustment is going to be getting over in 2 to 3 quarters. But coming to your specific question on services, see, one, I think this whole notion that India has 60% of GDP services, and then in this we need to get that services are somehow high contact. We have to remember that a large part of these services is linked to manufacturing itself. So like the biggest part is trade, that is retail, wholesale, repair of motor vehicles. There is a lot of business services, telecom, public administration, defense. So all of these services have been very much on, right? Utilities, construction is doing okay because steel and cement demand are fine. So I think the services which are currently affected badly are entertainment, most importantly education. Then I think entertainment, travel, tourism, and all that. And some of those are starting to recover. I mean, for example, you must have seen now that even Terminal 1 in Mumbai is now to be restarted because the traffic load has actually picked up. That will leave only the long distance rail, which also is up now about 70%. The restart of schools, the restart of say school transport, which if you remember, it's like 1,20,000 crores is just the annual cost of sending kids to schools and colleges. I mean, all of those businesses picking up would be the last sort of light switch to go on in the economy. Will there be lasting implications of this? So we have to remember that one is the inequality aspect, which I think Dr. Sen and you also mentioned, Niranjan talked about it. And I think as a democracy, as a society which is focused on socialism and equality, is something for us to ponder over, and the fact that the government does not have the tools to address it directly without causing leakage. But from an economic growth perspective, so when I sit down and forecast economic growth, I don't worry too much about that, right? Because the bottom 50% consume pretty much the same as the top 10%. That's a lot of inequality, but from an economic forecast perspective, that's what matters. And in the bottom, the consumption basket of the bottom 50%, the discretionary demand is actually very small. Most of what they consume is non-discretionary: food, basic attire, telecom, basic schooling, etc. Now, if you project it, I mean, what is the impact of this? The impact is more on their balance sheets. Impact is on the stress that they're carrying in their minds, because the discretionary demand, which will of course be affected, which is why two-wheeler demand is doing much worse than four-wheelers. Four-wheelers also have not fully recovered yet, but two-wheeler demand is doing much worse. So the low income households' discretionary demand is where I would expect to see continued stress for quite a while. because I think it will require at least 4 to 6 quarters for them to actually recover fully. While on that, on last point, the way to address that stress, given that the government lacks the tools to address the urban poor, urban destitution, the best solution for that would be to get the rich to spend, meaning many of these services which are restricted are where the rich buy the time of the poor. And so freeing up that spending could actually be the best antidote to some of this stress. But I don't see the balance sheet damage getting away very quickly.
With that, I think we are now running out of time, but a very quick question to Samiran before I ask the last question to everyone. Samiran, what are the key risks that you are seeing to the outlook in the coming fiscal? I mean, everyone is talking about a very sharp rebound in growth. The GDP size may not rebound that sharply, but I think the growth is at least showing a sharp rebound. And is there any risk to that apart from COVID-19?
DK, I guess the big risk is that the asset price movement have become so volatile over the next few months that it creates its own level of both uncertainty at the business investment side as well as on consumption side by impacting it through the wealth effect channel. The second risk that I would look at is that to what extent these volatile movements forces the hands of policymakers, and we can see some amount of premature tightening, and that could potentially lead to this fragile economic recovery getting derailed again. But I guess the more important part, and I will take a cue from Dr. Sen here, is that the nature of economic recovery that we are seeing, which is entirely a K-shaped one, where a lot of emphasis is there on large farms, formalization, etc. How sustainable that recovery is over a longer period of time without proper distributional policies in place, especially if it is not creating enough new jobs in the system, it's more capital intensive and technology intensive, then I guess what we see as a recovery in FY22 could very well fizzle out as early as FY23 also.
Thank you, Samiran. And I think let me now ask what I think what's like a rapid fire question to everyone. I think what is your outlook for 21-22 as far as GDP growth is concerned, and looking beyond that for the next 3 to 5 years? Let me start with Neelakanth.
Yeah, I expect 14% real growth in FY22 and 6.5 to 7% annualized real growth for the subsequent 5 years.
Niranjan? Niranjan, you need to.
Yeah, I've done it. In the new year, 21-22, I expect the recovery to be quite sharp. So it will be in double digits, perhaps 11 or 12%. Less confident about the medium term. I would say somewhere between 5 to 6%, given current information.
Samiran?
Well, you can reduce Neelakanth's numbers by 100 basis points and you will get my number, both in the short term as well as in the long term.
Okay, and Dr. Sen, what is your assessment?
Well, I'm the most pessimistic of the lot. So for the coming year, it's going to be 9%. But on the long term, I think Niranjan, Samiran, and I are on the same page, which is somewhere around 5 to 5.5%.
Well, all right. Thank you very much. And let me try to quickly summarize. This has been a very rich session and not easy to summarize. So I think we are not fully out of the woods. I think and pandemic does leave scars in the economy, which will require policy support. And as Dr. Sen said, we should be open to surprises in GDP data, particularly when the revised estimates come out. Monetary fiscal coordination is clearly entering a very difficult phase, and the trade-offs will become more pronounced in the coming year. And the challenge of taming yields is for all central banks. I think the markets don't seem to be listening that intently to what the central banks are saying. And then I think there are some positive tidings as well. I mean, and this is particularly on the investment front, and revival of investment is very critical for sustaining long-term growth, because we will see the policy, fiscal or monetary, normalize over a period of time. And I think the PLI scheme will add momentum to that investment recovery. On that a bit positive note, let me conclude this session, and I would like to thank all the panelists for this wonderful session, and also to all the audience for listening in. And I have tried to blend the questions when I asked the audience. I think I also incorporated the questions from the audience there. So we have covered the audience questions as well. Thank you very much.